Everybody wants the same thing. Pay off the mortgage. Own the home outright. That's the dream. But for a lot of Canadians, rushing to pay off the mortgage first before doing anything else with their money is the single most expensive financial decision that they'll ever make. And nobody at the bank gets paid to tell you that. When I sit down with clients, it almost always starts the same way. Aleem, I want to be mortgage free. And I get it. But here's what most people forget. Your mortgage payment disappears, yes, and that's great, but your expenses don't entirely disappear. Property taxes are still there, and they go up every year. Maintenance, still there. Your roof doesn't care whether you have a mortgage or not. Strata fees, if applicable, utilities, insurance, all still there. So now you've got, let's call it $800,000 locked inside your home. You feel great about it, and you should. That's real wealth. But here's the problem. Can you buy groceries with home equity? Can you pay your property tax bill with equity? Can you fund 20 years of retirement, the travel, the family, the life that you actually built with equity? No. The only ways to access that money are sell, downsize, or borrow against the house. All three come with a cost. Realtor fees, legal fees, land transfer tax, moving costs, or a reverse mortgage. Interest compounding against the equity that you spent decades building. When all your wealth is locked inside a single asset, your options in retirement are limited. That's not a plan. That's essentially a gamble. So let's talk about the alternative. And this is where Canada is different from almost all personal finance content that you see, because most of it is American. Here's the math. Say you've got $2,000 a month that you were planning to throw at your mortgage. Over 10 years, that's $240,000 in extra payments. Your balance drops, and this feels good. But what if instead you invested that same $2,000 a month at a conservative 6% rate? After 10 years, roughly $325,000, still growing, and your mortgage is still being paid down on schedule through your regular payments. You didn't lose anything, you just didn't rush. Now, here's a formula that you can screenshot. If your mortgage is at 5% and your TFSA can return 7%, the gap is 2%. Over 10 years on $2,000 a month, that gap alone compounds to roughly $48,000. Now, this is not an opinion, it's arithmetic, it's math. And that $48,000 is the cost of rushing to pay off your mortgage. This is where the equation shifts for Canadians specifically. Are you maxing out your TFSA before throwing extra money at your mortgage? Because a TFSA growing at 7 or 8% tax-free is mathematically beating a mortgage paydown at 5% every single year. And the CRA can never touch that money, ever. Your RSP, same idea. You get a tax refund on the contribution, often 30%, 40%, even higher depending on your bracket. Then that money compounds tax deferred for decades. The bank will never bring this up because the bank wants your mortgage balance as high as possible for as long as possible. They collect interest either way, but the order that you do things and invest first, then accelerate the mortgage, that's where the wealth gets built. Here's something most people never consider. Instead of putting that extra money towards your own mortgage, what if you used it towards a second property? Now, you've got a tenant paying down that mortgage for that property. The property appreciates. You're building equity in two places instead of one, and you're generating income. Your primary home is still being paid off on schedule. Nothing changes there. But now you have an asset outside your home working on your behalf. That's how a lot of people built real wealth in Canada, not by rushing to eliminate their mortgage on their primary residence, but by using the position that they're already in to acquire more. Now let's put these side by side. 10 years, $2,000 a month. Option A, you pay down the mortgage faster. Your balance drops by $240,000 plus interest saved. That's real, but that money is locked up inside your home now. You can't access it without selling or borrowing. Option B is invest inside your TFSA after 10 years, roughly $325,000 liquid, tax-free, still growing, and your mortgage is still being paid down on schedule. The difference isn't just the $85,000 gap. It's what $325,000 gives you that home equity doesn't. It gives you options. If an opportunity comes up, a business, a second property, an emergency, you can access that money. You can't do that with home equity without a trip to the bank and a new application. There's another layer to this that nobody talks about. The bank sends you a statement every month. You see your mortgage balance going down, that's a dopamine hit. It feels like you're winning. But what that statement doesn't show you is the other side of the ledger, the compound growth that you're missing, the wealth that you're not building. Banks design their interfaces to make debt repayment feel like progress. The number drops, you feel good, you keep sending them that money. Now, they're not going to show you what that same money could be doing somewhere else. That's not their job, but it is your money. So you're probably thinking, okay, Aleem, but what about the risk? Markets go down. The mortgage paydown is guaranteed. Fair point. And yes, investing carries risk. Nobody's denying that. But think about this. Putting all your wealth into a single property, one asset, one city, one country, that's its own form of concentrated risk. You're betting everything on Canadian real estate. Diversifying across different markets, different asset types, that's actually the safer long-term play. It doesn't just feel safer because you can watch the stock market move every day. You can't see your home equity fluctuate, but it does. And one caveat, if you've got high interest debt, credit cards, lines of credits at 8, 10, 12%, pay those off first, always. No investment beats a guaranteed 12% return. There's one more piece that most Canadians have never heard of. In Canada, there are legal ways to structure your mortgage so that interest becomes tax deductible. It's called the Smith maneuver or cash damming. When your mortgage interest is working for you instead of against you, the entire pay it off first argument completely falls apart. We're going to do a full breakdown on that in another video. But here's the bottom line. Paying off your mortgage is not a bad goal, but rushing to do it without considering what else that money could be doing could be the most expensive decision that you make. If you want to map out what that looks like for your specific situation, book a call with me. I've got my link to direct access for an appointment in my bio, and I'll walk you through this, no obligation. If this gave you something to think about, hit like, subscribe, and share it with someone who's been asking. I'm Aleem from the Mortgage Free Faster channel. See you on the next one.